Hi guys, welcome back to my channel where we discuss everything ACCA. My name is Zaid Sayed, and today I am going to start a new thread on financial reporting. Now, what do I intend to cover here? Because obviously, financial reporting is something that gets covered extensively throughout ACCA, and for that matter, for any accounting qualification, whether you're in college, whether you're studying for CA, CPA, etc. Financial reporting is a very important element of that. So, what we're going to do is that today we will start talking about some of the key standards that gets examined, and to be fair, using my industry knowledge of almost 15 to 17 years of working, I would like to bring in some of the common areas where you have to really use this knowledge, right? So without further ado, let's talk about the standard that I really wanted to talk about. Now, this is a standard which is probably one of the most basic standards and still the most examined, the still most used. And even if you go in the industry, this is something that becomes the most relevant standard, which is IAS 16, property, plant, and equipment. Okay. But before we do that, I think it is important to understand that what is IAS. Now, before we start talking about IAS, let's understand that what is IFRS, because IAS, IFRS, they are all one and the same, right? So IFRS is International Financial Reporting Standards. Now, the reason why you have IFRS, which is, by the way, implemented throughout the world, major economies are using these reporting standards. There are just two to three main reasons. One, that the financial statements are consistent, the financial statements are transparent, and the financial statements are comparable throughout the world, right? Because what was happening, let's say in India, because I want to really talk about why it is important for us, is that when you talk about India, we are one of the fastest growing economies, and we can't just grow by only taking care of consumption within the country. We have to make sure that we are able to export as well, right? And therefore, if you want the investors to come in India, they will not be able to invest unless and until they are able to understand the financials of companies in which they are going to invest. Therefore, let's say if I have a manufacturing unit and I am a manufacturer of, let's say, chips that goes into your computers, your mobile phones, etc. Now, let's say a company like Apple, if they want to invest in my company, they say that, Zaid, you know what, we need a lot of chips throughout the year. We want to invest in your company. We want to help you set up a much larger plant, right? Uh, of course, they will ask my financials and see how well I'm doing, because they will not just partner up with any random company, right? Now, if I give them my financials, if they are not in the same language that they use, and when I say language, it's not about English, it is about accounting language. Do my assets definition meet the definition that they use? Do my liabilities definition meet the definition that they use? And all the other thing that becomes part of the financial statements. So therefore, to make sure that there are no disconnects like these, because we continue to increase our footprint globally, it is important for the country as well as globally that we all start to use same set of accounting standards, and that's where IFRS comes in. It makes sure that globally all the companies are using the same accounting language, so that you are able to invest anywhere in the world. Okay. Now, why do we need to know in India? We have to know is because it has been already implemented by the MCA. In fact, all the companies that are currently listed on the stock exchange are supposed to have IFRS or the Indian version of it, which is Ind AS, right? Ind AS is the converged version of IFRS. When I say converged, it means that almost 95% of the IFRS has been accepted in India. Of course, there are some small exclusions, which MCA, by the way, is currently working to make sure that there are no exclusions, there are no carve outs, right? Or carve ins, another technical word for you, right? But of course, India being a very different economy to, let's say, other economies in the West, we needed some time to make sure we're able to match up, and therefore, we have these small differences. But for now, that's too technical for you, and I don't want to get into that, right? So, as you can see, like I was telling you, there are 140 jurisdictions that are currently using standards, and you can see almost all the top economies across the globe using it, including Russia, Philippines, Australia, Malaysia, Hong Kong, UK, Europe, of course, right? The most two important characteristics of IFRS is relevance and faithful presentation. And if you think about it, that when you were being taught audit, let's say, the auditors are always looking to give a true and fair opinion. How will they give a true and fair opinion if your financials are not going to give the same? That's why your accounting standards do focus on faithful presentation, on relevant presentation, and they are made to make sure that they are comparable, they are presented in time, expected by the stakeholders, etc. Right? Some of the key financial statements are statement of financial position, statement of P&L and other comprehensive income, statement of changes in equity, cash flow statements, and notes to accounts. Right? When we talk about IFRS, it is principle based accounting. That means there are not exact everything absolutely given to you, that this is black, this is white. There's always a gray, right? Because when you give a black and white, let's say a rule based accounting, people find loopholes, right? So that's why if you have been given a principle that this is how an asset should be, this is the common things that should be there in an asset. Now whatever is there out in the world which meets this definition becomes an asset. So you do not go back to the user of the financial or to maker of the financial that this is a computer, this is a car, this is a machinery. You don't do that. You say that, look, this is the definition of the asset. If it is meeting this definition, this is your asset, right? Now, when I started talking about the concepts, this is something that I really want you to understand. That when we are talking about IFRS standards or IAS standards, by the way, I forgot to mention that IAS are international accounting standards. It was the series that was used before IFRS, right? Now, to give you a bit of a background, when you look at it, it is international accounting standards, whereas the series that are currently used are called international financial reporting standards. So you can see there is a difference between, there is a shift just from going from accounting to now reporting. So when you are accounting, it merely means that you just want to book an entry. But when you are reporting, that means you are recording it from a point of view of the users of the financial statement. So therefore, it is important from a preparer's point of view that when you are preparing a financial statement, always keep in mind the investor's perspective. Always keep in mind the users of the financial statements perspective. So that's why IAS has been, it stopped now and it has been now moved to IFRS, right? Otherwise, the whole logic is the same. They are all accounting standards, they are all reporting standards. But any new standards that are now coming out, they are in the IFRS series. Okay. So now coming to the journey, right? If you want to really become an expert in IFRS, if you want to become an expert in bookkeeping and reporting, right? And trust me, there's a huge scope out there in the market for people who can understand IFRS really well. Is that, remember that any standard goes through this journey, the journey of 5 steps, right? What is this? What are these 5 steps? Initial recognition, initial measurement, subsequent measurement, disclosure, and de-recognition, right? So for anyone who wants to understand any accounting standard, it is important that you understand these 5 steps. Why? Because this is all that is there in an accounting standard. Now let's start to discuss one at a time, and then in today's session I really wanted to use property, plant and equipment as one of the key things. If time permits, we will cover very quickly IS2 inventories as well. Okay, so when we talk about initial recognition, there is a framework that has been given by IFRS which tells you when can you recognize an asset or a liability. So if it's an asset, right, you can only recognize an asset in your financial statement when the control over the asset is with you, right? When the asset is going to give you future economic benefits, when the asset is a result of a past event, right? These are some of the things that are part of the definition given to you for an asset. So therefore, if there is a room that you check in a hotel, right? Now you will say that, look, I've checked in, and this room is very much in my control, so this becomes my asset. But do you have the title to the asset? No, you don't have the title to the asset. The other very basic question that you need to ask is, because this follows control, does the risk and reward associated with the asset ownership lies with you? What do I mean by that? So let's say if you have this hotel room. Now something happens to this hotel room. Let's say tomorrow there is a fire in the hotel, and this hotel room is now completely burnt, right? It is now inusable, right? So now, would you have to pay any monies from your pocket to repair this room? No, because you'd only checked in for a night. Why will you have to spend it? So therefore, now remember that the risk and reward associated with that room did not lie with you, which becomes a very fundamental requirement of an asset. So therefore, initial recognition, if you really want, you need to make sure that the control which follows by risk and reward associated with it should be with you. If that's the case, you should be able to recognize that asset. And in the same way, if there is an obligation and you will have an outflow of economic resources, then it becomes a liability which you can record. Then comes the next step, which is the initial measurement. Now, when you talk about the same context of hotel, but this time I'm saying that you bought the hotel, right? And this hotel is yours. How much do you value that hotel? Do you value it at how much you've paid, or how much is the actual value, which is, let's say, market value, or is it just any random value you can take? Now there is very, very, very clear instructions on how you can measure these assets, liabilities, etc. And like I said, when we discuss about IAS 16, I will talk about how do you go about measuring this, the value that you will record initially. Like for example, if you have bought the asset, typically you would have paid the monies to the seller. That automatically becomes your initial value that you will account for in the financial statements. Of course, there are multiple standards that allow you a subsequent measurement, which is the next step, where you are able to use a market value as well, right? A market value, or a better word these days used as per IFRS, is your fair value, right? So if, let's say, I had bought a property in Mumbai 20 years ago, I'm sure people would definitely know this, that the value of the property today versus 20 years ago will not be the same. So if I had bought it for, let's say, 10 lakh rupees, in almost all likelihood it will be a 1 crore today, right? So therefore, I need to make sure that I'm able to show that fair value to my users of the financial statement. So I am allowed to show that asset at 1 crore today. So that's your subsequent measurement. Okay. Then comes disclosures. Now one may say, disclosure, what does it matter? No one really knows. But believe you me, as per IFRS, there are over 3,000 disclosure points, right? Now you must be thinking, but who looks at him? It is a problem. But if you look at it from IFRS point of view, because I said that these standards are now being made from the users of the financial statements point of view, the IFRS world wants you to look at these disclosures as well. So if there is an asset, at what value are you accounting for? Under what depreciation policy are you depreciating? If you have revalued, how did you go about revaluing the asset? All these things you need to put it in your disclosures, in your notes to accounts, so that the users are able to get a better perspective, right? Because remember, the devil is in the detail, right? So you need to make sure that you're looking at these disclosures as well. Even if you're not looking at it, IFRS has made it absolutely clear to the preparers of the financial statements that everything that you have on the financial statement, if there is a disclosure that needs to go, it should be put in the financial statements, right? And the last comes your derecognition, which is about when do you go about derecognizing the asset. That means that I had this hotel today, but as soon as I've sold it, I no longer have the control over the asset. I no longer have the risk and reward associated with the asset, and therefore I will derecognize it from my financial statement, right? So this is the journey, and I would urge you guys that wherever you are and whatever you are studying, if you have an interest in understanding IFRS in detail, and believe you me, it's a great space to have your expertise in. There are MNCs out there, there are companies out there who are constantly looking for experts. These are the 5 things that you need to identify for each and every IAS and IFRS out there, right? There are some 23, 25 odd IAS that are still available to be used, and there are some 17 odd IFRSs which have been released, which you're supposed to use, right? Now, coming to the IAS 16 in the context of the 5-step journey that we spoke about, because like I said, today I really want to focus on the property, plant and equipment, right? Of course, we will also very quickly run through IAS 2, because this is another standard that gets very regularly talked about, examined, etc., right? So let's talk about our initial recognition. So when we talk about initial recognition for IAS 16, right, like we discussed already, that the asset should give you a future benefit and should have a reliable measurement. Now, let's talk about some real world examples. So one of the guys I speak to, they have in their financial statement, they've got cars that they account for as assets, but in that fleet of cars, right, there are a few cars which they are no longer using. Okay, they are no longer using because there's a government policy that you cannot use cars which are 15 years older, but they are still parked, and the client thinks that no, this is still an asset because it still runs. If I want to, I can still move the car around, and it still moves from point A to point B. So yes, that's fair, if it is still usable. But remember, it says that does the company give a future benefit. Now, from a company's point of view, if the government has a regulation that you can't use these cars, that means this is now rendered useless. You will have to scrap it now. You can't even get any scrap value for it. For all I knew is that when you had to scrap it, you had to pay the people to pick up the car and then put it through a crushing machine, right? So therefore, instead of in fact recording it as an asset, I had to ask them to book a provision for them to be disposed of, right? Look, this is the difference when you know you understand the concepts and you understand the standards well, right? So the very same cars which were supposedly assets to the company have now become a liability, right? Because we said that you can't recognize an asset if there is no future benefit. And the same goes for reliable measurement. Why a reliable measurement? Let's say I have bought a car today. Now I don't have a cost to it because my friend said, look, Zay, don't worry, we will talk about it. I will let you know what the price is, etc., etc. Now I have got the car, but I don't know at what value I'm going to record. Now tomorrow when the auditor comes and I'm saying, oh look, I have an asset, this car, and I'm going to show it, but at what value? Right? How am I supposed to tell my auditor that this car that I have is worth 20 lakh rupees? Right? There needs to be some paperwork. Either I have bought it from my friend and I've given him 20 lakh rupees, or there is a market value that I'm using. There is an independent valuer who's issued me a certificate to say, look, Mr. Zahir, this car that you have is worth 20 lakh rupees. So therefore, because the auditor has to give an opinion on its truthfulness and fairness, unless and until you don't provide these evidences, there is no reliable measurement there, right? So therefore, both of these things are important for any cost to be recognized. Moving on to the initial measurement, like I already discussed, if there is a cost to it, whether you have purchased it at whatever cost you purchased it, you record it, right? So let's say you bought a plant and equipment, right? Any kind of plant and machinery, you would have bought it, so you would have paid something. That money is automatically gets recorded as the cost. Or if you have developed a plant yourself, whatever monies that you have spent in developing that asset, including the loan that you took to, let's say, buy material, buy anything, all of that borrowing cost can also be recognized. There is a standard called IAS 23 borrowing cost, right? And maybe one of the sessions I'll discuss that. It allows you to recognize and capitalize these costs as well. But coming back to IAS 16, right? All the monies that goes into making that plant or machinery can be recognized as your initial cost. But when you come to the subsequent measurement tells you that, guys, look, you've got two methods which you can use. One is your cost. So the cost that we just spoke about, of course, along with that, there will be an accumulated depreciation that you need to reduce, especially on PPE, right? Sorry, on the plant and equipment. Of course, the land usually will not get depreciated, but your plant and equipment will. But if, let's say, the company decides that I want to use a revaluation model, now the revaluation model works on the same lines as the fair value we spoke about little earlier. That if there is a market value of something and you feel that it gives a better representation of the asset's value, because at the end of the day, remember, it is the users of the financial statement, you have to work with their perspective, right? So if you think that using the fair value is a better way of showing this asset, use the revaluation, right? So if there is a property that was 10 lakhs and now become 1 crore, use that 1 crore and park that extra 90 lakhs in a new section that IFRS brought in, which is known as other comprehensive income, right? Short form OCI, right? So you will be able to park that extra 90 lakhs over there. Why are you parking there? Is because, let's say, if I am a regular businessman and if I park this 90 lakhs, which is, by the way, I've not recognized, I've not realized this, I've not sold the property yet, right? It is just that I came to know the 10 lakh property today has become 1 crore. So that 90 lakhs is notional right now. But because it is the true representation of the asset, I will book that 90 lakhs, but in the OCI, which is available for me to park things which are not necessarily for the current PNL, right? So it reduces my volatility. And again, in one of the sessions, I will also talk about how does the OCI help the financial statements. But just for now, for your understanding, this revaluation, if there is an excess, 10 lakhs went up to 1 crore, you will be able to book the excess in the OCI. On the other hand, let's say it was 10 lakhs and now moved to 9 lakhs, you had a 1 lakh loss, that goes to the PNL directly as a loss. Now you must be thinking, why is that the case? If you are taking the profit to the OCI, why take the loss to the PNL? The concept here is of prudence, right? What IFRS tells the preparers, that always be prudent in making financial statements. Don't show a rosy picture when, if it does not turn out, it becomes a big loss for the investors, right? On the other hand, if there is a possibility of making a loss, make sure that you are booking it, disclosing it, talking about it, because it is better to show not so rosy picture rather than showing a rosy picture and then turning out to be a case like Enron, right? Now, if I am talking about Enron, I really hope that you as accountants know what happened to Enron. And if you don't know what happened to Enron, I will urge you to have a look at an Enron case study. There are multiple case studies available on YouTube, right? There are 5-minute, 10-minute, hour-long case studies. Pick up whatever so you know what happened to the Enron. But coming back, right? So make sure that if there is a revaluation, book it in the appropriate area. and then move on to the disclosures. Like we discussed previously, that when you are talking about PPE, right, you have to disclose what is the measurement base, is it cost, is it revaluation model, and what is the useful life of the assets. If I have a car and the car is only 5-year useful life, I should tell the users of the financial statements that this asset is going to only last for 5 years. How does it matter? It matters because the users of the statements now would know that if this plant, if this car, if this, let's say, land and building only has 5 year, 10 years of life available, the users will now know that in 5 years time the company will need the money again to refinance this. And if the company is not doing well, the company does not have the money to finance it, then they know the company is in pickle, right? And yeah, they are then able to make a better decision about their investments, because if they think the company will not be able to survive, then they might even exit the investments, right? So these disclosures, now you may understand why it is helpful, because the users of the financial statements will be able to take a much better decision when it comes to the investments. Moving on to the last step, which is derecognition. Now when we talk about derecognition, like we said, that if you do not have control over it, if you do not like a disposal, or there are no future benefits coming out of it, like the example of the old car that I gave, derecognize the asset. It is no longer meeting the definition, de-recognize the asset, right? So that is your IAS 16 property, plant and equipment. But of course, there are multiple anomalies, there are multiple things that are there, and I would love for you guys, to go to IS Plus. There is a website which gives you in detail all of these 5 steps that you see for all the standards. So feel free to go to that website. You will be able to get a lot more information from there, right? If you want to very quickly, I'll talk about the IS2, which is inventories. A lot of things are same: future benefit, reliable measurement, cost. The only bit here is your subsequent measurement, where there is lower of cost, or NRV is the principle that you use for accounting the inventory valuation. So what happens is, because inventory is very dynamic, today it is being sold at 100, but let's say fashion changes and people no longer want to buy this cloth or this jeans or whatever, you are now having to sell it at 50 rupees, right? So what happens is, the logic here is, the company needs to record its inventory lower of cost, or NRV. Now NRV is your selling price less selling cost. So here, if your jeans, which was costing 80 and you were selling at 100, it was fine to keep it at 80 at the time, because your cost was obviously lower than the selling price. But when your selling price has now dropped below 80 and now being sold at 50, you will have to record it at 50 and you will have to take that write down, right? So that's your IAS2 inventory subsequent measurement. In terms of disclosure, similar bits, accounting policy for accounting, because there are multiple ways that you can account for inventory. There is FIFO, so there is cost actually. Then there is FIFO, which is first in first out, and there is a weighted average cost as well, which is also known as AFCO, right? So you can use any of these costing models to value your inventory. And then comes your derecognition, and the bits are the same, right? So of course, very quickly to wrap it up, because this is just my first session and I really wanted to give you a feeler of what IFRS is, and IS 16 makes the most appropriate sense when it comes to IFRS standards, right? So IFRS is really important for our economy. It helps us bring in more business, more investments, FDIs, FIIs, you name it. Like, we've got Make in India. So all of that will happen only when our financials are readable from the investor's point of view, no matter in what part of the world they are, right? So the IFRS standards are here, therefore make sure that your conceptual clarity is definitely there. Do look up at courses like DIP IFRS or ACCA, because It will give you a great overview, or in fact in-depth details as well on what these standards are, right? There are multiple websites like ACCA Club India which you can subscribe to. You can, go to their website and look for such such articles that can help you. And of course, if you need any further details, or if you want any other standards that you would like me to cover, you can always drop me a comment, and I will be more than happy to come back to you. I hope you enjoyed this session. Like I said, I wanted to keep it light, I wanted to keep it brief, right? But yes, if you do have any questions, including about IAS 16, please drop a comment. And if you've liked the video today, do like and subscribe to my channel. Thank you so much.